Good morning. Welcome to Stock Market Today. It's Tuesday, May 12th, 2020, and I'm your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show as well as give you daily stock ideas. It hits your inbox every trading day before the market opens. So U.S. equities were mixed in Monday's trading, with the NASDAQ leading the charge once again. Healthcare, tech, comm services led. Sound familiar? Financials were the worst of the bunch. Treasuries were weaker across the curve. The dollar was stronger on the major crosses. Gold finished down 90 basis points. Oil was weaker. WTI settling down about 2.5%. So outperformers, healthcare, tech, comms, throw discretionary in the mix. Underperformers, fins, energy, materials. As we get to the desk this morning, futures are flat to slightly higher after Asian markets were mostly lower overnight. European markets are mostly higher. Treasuries are unchanged to stronger at the back end of the curve. The dollar is slightly weaker on the major crosses following Monday's strength, and gold up 60 bips, and WTI crude adding on about 3% here on a Tuesday morning. So for the structure of the S&P 500, I kind of wanted to call it Groundhog Day, but, opted for we're knocking on the door. We're knocking on the door of the breakout level. We still have the 200-day moving average just above at 30.01, right? So 29.50 breakout level, 200-day moving average, 30.01, declining to flat. 27.50 to 2800 as initial support, 24.85 to 26.60 below that. As I started to lay out in my note yesterday, and I reiterated on this call, and I'll reiterate it here again today, I think that if you get a breakout through this 200-day moving average, you're immediately thinking of, 3,100, 3,111. And then if that gives way, you have to start thinking about the highs, right? Probabilistic roadmap type thinking. If we break above the 200-day moving average, you have to think we get a quick 100 S&P points. And then above that, you have to start thinking about the highs. We're not overbought. We're not oversold. Chaikin money flow dips bearish. We'll see if it can quickly rebound. But that's kind of how I'm laying out the market here right now. To the downside, I think if you break 2,800, right, you can start to see the clear roadmap. Then you're looking at the 50-day. And if that gives way, you're kind of looking at the key retracement levels. Again, nothing precise, no forecasting, no predicting. Roadmap. If this, then that. And how do you act accordingly? Are you mindful of what's outperforming? Looks to be the Qs, doesn't it? Mixed session for equities as we look at our market in a minute. What are we writing about today? Leadership by QQQ. The Qs are up 6 days in a row, and tech remains strong leadership. Well, healthcare waivers, we're going to take a look at that. It's Tuesday. We do our sector rotation work. We're going to take a look at tech and healthcare on relative basis here today, where one is solid leadership and one is leadership but wavering. Financials and industrials make new relative lows, and that's kind of interesting because if you're interested in the reflation trade, you have to think industrials will lead, and they're not. And financials, I can't start to help but wonder if the financials are the next energy. Just an utter disaster on a relative basis. We're watching short-term rates as Chairman Powell is set to speak tomorrow. Fed fund futures last week started pricing in negative rates here in the U.S. And I guess the key is never say never, right? We see them globally, so why can't they come here? Futures point to a slightly higher open here today. Taking a look at the major indices now from a power bar perspective, the Dow loses 43 bips yesterday, 2 to 16 bulls to bears. S&P 500 up slightly, 59 to 155. There's your NASDAQ. There's your outperformance. There's your Qs. There's your large cap growth. We've been talking about it for I don't know how long. At this point, if you're not positioned in large cap growth, I have to question what you've been watching in the marketplace. 28 to 15 bulls to bears. Small caps underperform, 354 to 339 on the ratio there. Bonds downtick, sending yields higher. Healthcare was a big leader yesterday. But again, we're going to look at that chart. Some interesting dynamics at play in the healthcare space. Up 1.72% and a solidly positive power bar ratio. I think ultimately we're going to resume upside, but we were keeping an open mind. According to the Chaikin Power Bar, large cap stocks, small cap stocks are bearish. Chart of the day. So we're going to pick on the fins here a bit, in particular the banks. And we're going to look at JP Morgan. I'm highlighting it in my note today as a bearish stock, type of name you want to avoid, type of name you potentially want to open bearish if that's what you do. Bearish Chaikin power gauge rating for a stock that has a weak trend and is in a weak industry group. The banks are weak. There's no two ways about it. Below the declining long-term trend line points to the weak trend. What do we have here? We have a bearish stock underperforming the market with the intensity of underperformance picking up. Overbought, oversold indicator couldn't even get to an overbought condition lately and is now moving back lower as money flow falls off a cliff. If you're a kind of classical chartist and you wanted to draw the line here, this is a triangle consolidation that appears to be resolving to the downside in the direction of the prevailing trend. I think if you wanted to, I think it makes sense. I think you could open bearish JP Morgan. Ugly stock. At the very least, I don't want to own it. Take a look at JP Morgan if that's how you trade. Potential opportunity to open bearish in that stock. Take a look at JP Morgan. At the very least, if you own it, you have to question why you own it. Let's look at our sector tracker now, the movement of the major sectors over the last 5 days. Tech, comms, discretionary at the top of the list. So tech and comms, top of the list. All is right with the world from a trend perspective on a relative basis. Healthcare, throw that into the top 4, and you basically have the leadership landscape that we've been talking about for 6 to 8 months at this point. Energy, materials, industrials, middle of the road, staples, REITs, fins, Utes, the bottom of the list with the fins and Utes negative over the past 5 days. It's kind of interesting. You know, the utilities are falling off. That's your safety trade. I mean, the message of the market is really mixed at this point. I think it really, you have to, stay engaged. You kind of can't just point to one thing and say, well, utilities are lagging, so the market has to rip. Well, the only way the market's going to keep ripping is if tech continues to do well, and that has been the case. So, because the reflation trade that started to pick up last week has kind of tapered off here a bit, right? So if we're looking for other areas in the market to kind of pick up the baton and run with it, nobody's really stepped up to do that just yet. In particular, I think you want to pay attention to a group like the mining services, right? If you're looking for broadening leadership within the market, right? We've talked about small caps to a degree, but I think you need to see kind of a shift in the theme, right? We've talked about small caps, but thematically, small cap growth, small cap tech, right, is leading within the small cap. I think, but that kind of jives with the growth tech that's been leading the market overall, right? So it's just kind of a fractal of a bigger picture theme. For me to really, really try to see where there's opportunities for further broadening, I'm going to want to see that reflation trade play out, right? For me to want to diversify away from growth tech leadership, I'm going to want to see the reflation trade play out. I'm going to want to see something like mining services start to lead it, and it hasn't. I mean, it's been a laggard, down by 18.6% relative to the S&P 500 over the past 6 months. Power bar ratio, though, is turning 8-7, right? Number 10 of 21 subsectors. Some interesting names there. MTRN, Nucor, Freeport, McMoran with bullish ratings. But if I look at the fund itself is a disaster, right? ETF rating is bearish. Weak trend below the declining long-term trend line. Bearish money flow, neither overbought nor oversold. But if you're playing for the reflation trade, if you're playing for a shift in themes away from, the large cap growth and consumer tech and fintech, you're going to want to see an area like this start to pick up, and it's just not there yet. It's not there. We'll watch it, but I can't get excited just yet. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers, our gainers and losers. Cardinal Health reports earnings. That stock moves higher by 6.75%. Vertex, some positive news out of CRISPR that is using Vertex's gene editing technology. CRISPR up big, Vertex up 5%. Take a look at that Vertex chart, breakout to new highs. Very bullish stock here at Chaikin Analytics, one of the stocks that we've been focused on. AMD up 4.75%, nothing company specific there. Stock continues to consolidate. Does kind of look interesting from a technical perspective. AbbVie, some of the big banks, likely the big banks that worked on the AbbVie Allergan deal, resuming coverage. Resumed overweight at Morgan Stanley yesterday, resumed overweight at JP Morgan today. AbbVie up 4.7% on those resumptions of coverage following the closing of the Allergan deal. And Biogen, BIIB, nothing company specific there, but that stock up 4.5% yesterday. Very bullish stock here. So the healthcare names doing what they had to do yesterday. And we're going to take a look just a moment. Loser side of the board, Under Armour. Reports earnings down 9.7%. ADS, nothing company specific to take 8% out of that stock. Host, HST, neutral stock down 8%. No news. KIM, no news, down 7.5%. And HWM, not rated here at Shaken Analytics just yet, but down 6.8%. Nothing company specific driving that. We are getting to the end of earnings season, right? So we get away from the macro, get back towards the micro, perhaps. Away from the micro rather, and back towards the macro. I butchered that. I think you get the point. We're getting to the end of earnings season. So tech, we said we talk about it. The trend is your friend. Look at this relative trend in technology. XLK against the SPY, just a nice steady uptrend. Now we started to watch as this consolidation played out within the context of diminishing momentum, right? Series of lower highs, potential bearish divergence. And what I said was you have to wait for a confirmation. Well, that confirmation never came, right? So that's your sell signal, right? The divergence is the wake-up call. The confirmation or a breakdown is your signal to kind of rotate, right? Take some sort of action. Till you get that, you stay the course. And hopefully you've stayed the course. Hopefully you remain overweight tech because you've been paid. No two ways about it. Having a disciplined process that focused on a bullish area of the market that was outperforming got you paid. And that's how it's supposed to work. What's interesting to me is now we've broken the downtrend line. RSI actually breaking this downtrend line. Now it's still a divergence, right? We're at a high, but we're potentially we could make a higher high on the RSI and then just, all is well. Nice uptrend. The trend is your friend until the end when it bends. We haven't bent yet. And on an absolute basis, nice topside breakout from a triangle consolidation, continuing to work higher. I think you have to start to think about the highs for tech. You have to start to think about the highs for the Qs, right? We've laid out the roadmap for the S&P 500. If certain levels break to the upside, that would cause you to start to think about the highs. But take a look at the Qs. We're almost there. They're about to fill. The Qs are on the verge of testing their gap from the Feb 24th breakdown, which was the breakdown that started the move lower. Which is pretty amazing if you think about it. But tech continues to do well, continues to be an area of the market where you should be overweight. An area of the market where you should be underweight, and really there's been no reason to be overweighted for quite some time, has been financials. Take a look at the XLF. I said we were going to pick on the financials a bit, and I am. XLF relative to the SPY, steady downtrend below a 200-day moving average, which is also declining. Accelerates to the downside as the market had sold off. What does that mean? The weak get weaker. Market sold off, tech kind of held in, stabilized, worked upside. The strong get stronger, the weak get weaker. Confirmed by momentum as the RSI remains in bearish ranges for the XLF on a relative basis. And I mean, just look at this chart, right? The absolute chart of tech is up here, right? On the verge of going near highs. Look at the fins. What do you want to own, folks? Now, I get it. If you're a mean reversion trader, if you're a bottom fisher, that's what you do. To me, it's a lower probability trade, but there are some people who do it and do it well. For me, I like the trend following approach. It's proven itself out over time. I think the financials are a wreck. I don't see any reason to get excited about them. Maybe this bullish divergence here makes me wake up, but again, you would need some sort of confirmation. So kind of wake me up when at least this interim high is broken, and realistically when this high is broken. And I'd be happy to pay more attention to tech in that environment, but I mean to financials in that environment. But until that plays out, I'll pay attention to them as a bearish idea maybe. And then finally, healthcare. I said we'd look at it, and here's the wavering, right? Notice tech broke topside, healthcare is kind of consolidating, and here's that divergence. So again, if we get a breakdown, that divergence would be confirmed. But until we do, it's just a warning. It's just a red flag. Kind of pay attention. So that's what we're going to do here. But tech's, healthcare is still leadership along with technology and continues to be an area of focus. Take us for a test drive, shakenanalytics.com/test drive. I'll be back with you tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.